about to be consumed by Microsoft. They looked at this fiscal 2026 guidance, and they economic uncertainty along with and by Q3, they reached
massive concessions. That doesn't prove long.
Fast forward to today, March 3rd, 2020. I hear that, I do.
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
On March 12th, 2025, the market delivered a swift and, frankly, brutal verdict on UiPath's trajectory.
Pause.
They had just released their fourth quarter and full-year fiscal 2025 earnings, and the immediate sharp after-hour sell-off was accompanied by incredibly heavy downside volume.
Tremendous volume. Yeah.
Exactly. Now, the raw numbers themselves weren't disastrous on the surface. They reported $424 million in revenue and roughly $1.666 billion in annual recurring revenue. But management issued a highly cautious fiscal 2026 guidance, and they specifically attributed this to rising macroeconomic uncertainty along with a pronounced softness in the U.S. public sector.
You know, that public sector weakness was the exact catalyst that fundamentally altered the market's perception of their sales cycle. It exposed just how heavily reliant they were on these massive, slow-moving government contracts to maintain their growth premium.
It certainly triggered a massive repricing of the stock. But, and this is the crux of it, fast forward to today, March 3rd, 2026. We are exactly 8 days away from their next major catalyst, which is the fiscal 2026 Q4 earnings release scheduled for March 11th. Over this volatile 12-month window, we've watched a company attempt to execute a massive narrative and operational pivot. And my stance is that they have actually succeeded. Okay? I look at the empirical data over the last year, and I see a genuine fundamental turnaround. We've witnessed a steady, undeniable acceleration in year-over-year revenue growth, climbing from a sluggish 5% in Q4 of fiscal 2025 all the way up to 16% by Q3 of fiscal 2026. Combined with their strategic pivot toward agentic automation and the successful completion of a really painful restructuring phase, I believe this platform is not just surviving but actively thriving in a new AI-driven landscape.
I come at it from a very different way. I look at that exact same 12-month timeline, and I see superficial top-line improvements that are actively masking deep, underlying structural vulnerabilities. This aggressive pivot to agentic automation, to me, it reads as a buzzword-heavy narrative. A narrative specifically designed to distract from deteriorating core metrics.
Just to clarify,
Let me just lay out the core issue here. Yes, the headline revenue accelerated, but when you look at the steady, relentless decay in their dollar-based net retention, falling from 110% down to 107%, and you pair that with massive, largely unexplained institutional offloading, you're looking at a deeply defensive company. A legacy automation vendor struggling to maintain its footprint against the gravity of hyperscaler consolidation, meaning the massive cloud providers like Microsoft and Google who are systematically eating into their market space.
thoughtful pause. I see why you think that, but let me give you a different perspective on how that financial rebound was actually structured, because it wasn't just a flash in the pan or a temporary bump from a single strong product cycle. It was a highly methodical quarter-over-quarter recovery. Let's just trace the progression of the fundamentals for a second. In Q1 of fiscal 2026, they posted $357 million in revenue,
Which was only a 6% increase year over year, barely keeping pace with broader software inflation, honestly.
Modest, I'll grant you that. But that was the floor. Because then Q2 accelerated to $362 million, hitting 14% growth. And by Q3, they reached $411 million in revenue, securing that 16% growth rate, with total ARR expanding to $1.782 billion.
Pause. Top-line reacceleration is always the easiest metric to highlight when a company might be aggressively discounting or bundling just to maintain market share. Getting a customer to sign a slightly larger contract today by offering massive concessions, that doesn't prove long-term viability.
That's an interesting point, though. I would frame it differently when you actually look at the bottom line. It wasn't just top-line revenue that improved. They proved the unit economics of this turnaround in Q2 when they became genuinely cash flow positive.
Right.
They generated $42 million in operating cash flow and $45 million in adjusted free cash flow. And perhaps most importantly, they completely phased out the drag of their internal reorganization. By October 2025, those accrued restructuring costs had dropped from nearly $9.778 million down to just over $569,000. They absorbed the shock, rationalized their cost base, and reaccelerated growth simultaneously. That is the very definition of operational execution.
Sigh. I'm sorry, but I just don't buy that the operational execution is as clean as those isolated figures suggest. Let me tell you why. It comes down to the quality of that growth. You cannot evaluate a subscription software company without rigorously scrutinizing its ability to expand its existing customer base. And UiPath's dollar-based net retention over this exact period is flashing a bright red warning signal.
You're focusing heavily on the drop to 107%.
I am focusing on what the trajectory actually means on the ground. In Q4 fiscal 25, right before this 12-month window began, retention was at 110%, which frankly, for an enterprise automation platform, is already on the lower end of the elite software tier. But then it drifts to 108% in Q1. It stalls at 108% in Q2, and then it bottoms out at 107% in Q3. For anyone tracking the space, 107% net retention means your existing customers are only expanding their spend by 7% compared to last year.
Yes, but
In enterprise software, once you account for baseline price hikes and normal operational scaling, 7% means you are functionally stalling. You are losing your pricing power at the renewal desk.
you have to contextualize why that expansion motion slowed down.
Furthermore, and this is the critical piece, look at the net new ARR, the actual new business they are bringing in. In Q1, they only managed to add $27 million of net new ARR. In Q2, just $31 million. Yes, there was a mild recovery to $59 million in Q3, but let's be intellectually honest about what these numbers mean. A software company failing to expand its existing customer base at historical rates is likely facing immense pressure, either having to offer steep concessions to prevent churn or finding that customers simply aren't scaling their bot deployments the way they used to.
I hear that, I do. But the pause and see eat expansion wasn't a permanent loss of pricing power. It was transitional friction as customers evaluated UiPath's new architectural paradigm. It takes time for massive enterprises to digest a fundamental shift in how the software operates. And that brings us to the March 12, 2025 acquisition of Peak.
Ah, yes. The Peak acquisition. Announced on the exact same day as the disastrous earnings release.
Yes. And I argue that acquiring Peak was a strategic masterstroke that fundamentally altered UiPath's trajectory. We need to look at what they actually bought. It allowed them to move aggressively beyond generic robotic process automation, which we can agree is becoming a commoditized space. RPA was about programming dumb bots to click buttons on a screen. Peak gave them the capabilities to build out a true agentic automation platform.
Pause. A buzzword that every legacy vendor is currently hiding behind.
It isn't just a buzzword if it fundamentally changes the workflow. With agentic AI, we aren't just talking about a bot copying data from an email to a spreadsheet. We're talking about an autonomous agent that can receive an invoice, realize there's a discrepancy in the supply chain software, draft an email to the vendor asking for clarification, and intelligently route the workflow without a human explicitly writing a rule for every single step. They needed Peak's vertical specialization to make that real, and the proof came in Q3. They didn't just announce theoretical concepts. They announced broad, deep agentic integrations with Microsoft, OpenAI, Google, NVIDIA, and Snowflake.
Thoughtful pause. Integrating with hyperscalers is not a moat. It's a toll you pay to stay on the highway.
I disagree completely. In the enterprise space, establishing yourself as the agnostic orchestration layer is incredibly defensible. UiPath is positioning itself not as a competitor to those foundational AI models, but as the critical governance layer that sits on top of them. Enterprises don't want autonomous AI agents running wild through their ERP systems without strict deterministic guardrails. UiPath provides that governance. It acts as the nervous system. The Q3 partnerships proved that the largest AI players in the world view UiPath as the necessary conduit to the enterprise workflow.
That is a compelling argument, but have you considered the timing and the psychological utility of the peak announcement? You mentioned it yourself. It was announced on March 12, 2025. The exact same day, management had to step to the podium and deliver a catastrophic guidance reset due to U.S. public sector softness. In the world of public market communications, you do not burn a major strategic acquisition announcement on a day when you know the stock is going to crater, unless you are desperately trying to deploy a narrative shield.
Or you are signaling to the market that you already have the solution to the macro slowdown in hand.
I see it as a survival tactic. By wrapping the legacy RPA platform in this agentic AI branding, they are trying to fend off platform consolidation. Let's talk about Microsoft for a second. Microsoft isn't partnering with UiPath because UiPath is irreplaceable. Microsoft is partnering with them because Microsoft's own Power Automate ecosystem is systematically swallowing the lower end of the market. They just want seamless API access to the messy, legacy, on-premise systems that UiPath still touches. I view the entire agentic pivot as a defensive maneuver designed to soften the blow of lengthening sales cycles, rather than a genuine organic growth engine.
We've talked extensively about whether the technology works and whether this agentic pivot is a moat or a mirage. But let's look at whether Wall Street actually believes this narrative. Let's examine the institutional trust. Because if you look at the long-term capital allocators, the institutional filings actually tell a story of immense validation. Let's look at BlackRock. On January 21, 2026, BlackRock filed a Schedule 13 GA, showing a massive accumulation of shares. They built their position up to 39.43 million shares. That represents an 8.6% stake in the company.
Pause. A substantial position, certainly.
You do not see the world's largest asset manager take nearly a 9% stake in a software company if they believe the core technology is just a temporary toll booth about to be consumed by Microsoft. They looked at the same 16% revenue growth we just discussed, the same positive cash flow generation, and the same agentic AI narrative, and they underwrote the turnaround. They bought the pivot.
But you are selectively ignoring the institutional exodus that happened right after the public sector warring. You point to BlackRock in January 2026, but look at the filings from Bank of America Corporation during the most critical phase of this 12-month window. As of March 31, 2025, just weeks after the earnings shock, Bank of America held 26.55 million shares, which is about a 5.6% stake. By June 30, 2025, they had drastically slashed that position down to just 10.22 million shares, a mere 2.2%. They dumped over 16 million shares in a single quarter.
Bank of America has a massive prime brokerage and derivatives arm. A regulatory filing reducing share count doesn't necessarily dictate proprietary negative sentiment from the bank itself. It could simply be client facilitation, hedging, or rebalancing across their various funds.
It could be, but a reduction of that magnitude, cutting the position by more than half, is an undeniable net reduction in reportable beneficial ownership. And this brings up a vital limitation in how we even analyze the stock's market mechanics over the past year. We are looking at these lit market filings, the trades that happen on the public exchanges, but we have a massive blind spot regarding dark pools and alternative trading systems.
You're referring to the off-exchange institutional volume?
Exactly. For those who might not follow market microstructure closely, large institutions often trade massive blocks of stock in dark pools, private exchanges, specifically so they don't spook the public market and crash the price while they are trying to exit. To responsibly quantify the true institutional sentiment, we need to measure UiPath's exact dark pool volume versus its lit market trading. We need to know who the off-exchange counterparties are, and without FINRA API OAuth 2 bearer tokens to access that granular data,
That data is notoriously opaque by design.
precisely. The regulatory framework heavily restricts access to symbol-specific dark pool data. The exact off-exchange institutional offloading remains a complete black box. We simply cannot responsibly quantify the total hidden selling pressure the stock has faced, but given the massive Bank of America exit we can safely infer that large pools of capital were quietly heading for the exits, using these dark pools to mask their retreat, while the company was busy pumping out press releases about agentic integrations.
Bref, I understand the limitation of the dark pool data and the inherent lack of transparency there. But I think you're weaponizing that uncertainty to paint a darker picture than the fundamentals justify. Even if certain institutions reduced exposure during the Q1 friction, the subsequent quarters proved them wrong. The company re-accelerated. And I think part of the reason UiPath was able to execute such a rapid strategic pivot, acquiring Peak, cutting restructuring costs to near zero, and integrating with the major AI labs all within 3 quarters, is because of their governance structure.
You're about to defend the dual-class share structure.
I am. Because in a highly volatile macroeconomic environment, when you are actively defending against hyperscalers and trying to architect a total architectural pivot from legacy RPA to agentic AI, you need a long-term vision. You cannot be paralyzed by short-term activist pressures demanding immediate margin optimization at the expense of research and development. The filings show that founder Daniel Dines holds about 19.2% of the economic interest when treating his Class B shares as converted, but he wields 84.2% of the total voting power.
A staggering concentration of control.
And a strategically stabilizing force. It guarantees that the engineering and product roadmaps are driven by technological necessity, not by quarter-to-quarter panic from Wall Street. Dines had the absolute authority to push through the restructuring, absorb the initial market hit in March 2025, and force the pivot toward orchestration and governance. Without that founder control, an activist investor might have stepped in during the Q1 dip, halted the Peak integration to save cash, and tried to strip the company down for a cheap private equity sale. The turnaround we saw in Q2 and Q3 was only possible because Dines had the voting power to stay the course no matter what the dark pool volume looked like.
I'm sorry, but that exact concentration of power is practically a permanent governance discount. It actively deters sustained, high-quality institutional investment. When an individual holds 19% of the economic risk but 84% of the voting control, the public markets are essentially subsidizing a private fiefdom. When a founder holds that kind of unassailable leverage, public shareholders aren't investors. They are passengers in a car where Daniel Dines has permanently locked the steering wheel.
That's a rather harsh characterization of a founder who literally built the RPA category from the ground up.
It is simply the structural reality of the equity. If management makes a strategic error in this transition to agentic automation, if, for example, the Microsoft or Google partnerships turn out to be Trojan horses that allow the hyperscalers to commoditize UiPath's orchestration layer, the public shareholders have absolutely no mechanism to force a change in leadership. They're trapped in the back seat. The 84% voting block means institutional investors have to price in a massive risk premium. And that governance discount, combined with the decaying net retention to 107% and the opaque off-exchange selling, leaves this company in a highly fragile, vulnerable state, regardless of whether they manage to squeeze out 16% revenue growth in Q3.
So we are looking at the exact same sequence of events, the exact same 12-month window, and arriving at fundamentally opposed interpretations of the company's health.
We are.
Thoughtful pause. When I step back and look at the totality of the evidence since that initial March 2025 shock, I see an undeniable empirical recovery. We have documented a clear, methodical, quarter-over-quarter acceleration, resulting in 16% year-over-year revenue growth. We have seen a return to positive operating and adjusted free cash flow, proving the unit economics remain highly viable, even during a transition. And structurally, the integration of the Peak acquisition and the establishment of broad, high-level partnerships with the world's largest AI models demonstrates a business that has successfully bridged the perilous gap, evolving from legacy deterministic automation into the future of governed agentic orchestration. The founder's control, in my view, provided the necessary stability to execute this massive technical and narrative pivot without being derailed by short-term market turbulence.
Thoughtful pause. And when I step back, I see a company where the top-line optics have certainly improved, but the foundation is cracking under the surface. The absolute decay in dollar-based net retention, bottoming out at 107%, tells me that the core customer base is simply not buying into the agentic AI narrative enough to expand their spend at historical rates. When you pair that loss of pricing power with the massive, multi-million share exit by institutions like Bank of America, and compound it with our inability to see the true off-exchange volume masking further exits, the underlying market sentiment looks incredibly weak. Add to that an ironclad 84% voting control by the founder that strips public shareholders of any real recourse, and you are left with a company that is far more fragile today than the headline revenue suggests.
The market will not have to wait long to test both of our theories. With the fiscal 2026 Q4 results scheduled for March 11th, exactly 8 days from now, the true fundamental impact of this 12-month pivot will be laid bare.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!